If you want to replace your paycheck with investment income so you no longer have to wake up every morning and trade your time for money, you need to understand one simple truth. If your job pays you $80,000 a year, then at some point your investments need to produce $80,000 a year. Not in theory, not on paper. In real cash flow, enough to cover the life you are already living. That is the entire game when you work a job. The paycheck only shows up because you show up, you stop working, the money stops. But when you own the right assets, the asset keeps working, whether you are in the office, on a plane, asleep, or sitting on your porch doing absolutely nothing. That is how you move from labor income to ownership income. And once you understand that difference, you start looking at every dollar you save in a completely different way. Now, I want to be honest with you before we go any further. This is not easy. It does not happen overnight. It takes capital, it takes sacrifice, it takes patience. In some cases, it takes real work and real skill. But it is possible. It has always been possible. And I am going to walk you through 5 kinds of assets you can use to build that income, moving from the simplest all the way to the most advanced. The first one is the easiest place to start, and that is treasury bonds. When you buy a treasury bond, you are lending money to the United States government. In exchange, they pay you interest for the use of your money. I like to begin here because the logic is clean and easy to understand. You put your money to work, the government pays you interest, that interest becomes income. There are obvious advantages to this. The first is that people generally view it as one of the lowest risk places to earn income because you are lending to the United States government. If the United States government stopped paying its obligations, you would have far bigger problems than your treasury investment. The second advantage is tax efficiency. Interest from treasuries is generally exempt from state income tax, which means in many cases you keep a little more of what you earn compared with something like a high-yield savings account. The third advantage is simplicity. You can build a stream of income that arrives regularly, even monthly, but I do not want you to romanticize it. Treasuries are not growth engines. If you lend the government $100, you are not turning that $100 into a thriving compounding machine inside the bond itself. You are collecting interest on that principal. The principal is not growing the way equity in a great business can grow. You are also capped by interest rates. If rates are high, the income looks attractive. If rates fall, that income comes down. And unlike a bank account, this is not FDIC insurance. It is not insurance at all. It is the government as promised to pay. Now, the easiest way to access this is either directly through Treasury Direct or through a Treasury ETF. A simple example is SCOV, which invests in short-duration Treasury bills. At the time this material was built, that fund was paying roughly 4.7% annually, and it paid monthly. The important thing to understand is that with something like SCOV, the real attraction is not price appreciation. The attraction is the interest stream. The fund price barely moves except around the dividend distribution because the product is designed to hold short treasury exposure, not to give you some wild capital gain. So if what you want is a relatively steady stream of income, and you are willing to accept lower return potential in exchange for lower drama, treasuries are a reasonable first building block. The second category is a little more advanced and, for many people, a lot more exciting. That is dividend-paying ETFs. There are large, profitable businesses in the world that generate more cash than they immediately need. McDonald's is a simple example. A company like that earns billions. And part of those profits get distributed to shareholders through dividends. If you own the stock, you are entitled to your share of that distribution. Now, you could go out and buy individual dividend-paying companies. You could buy McDonald's or another strong dividend stock and collect those quarterly payments. But that requires you to stay awake. If management deteriorates, if debt gets out of hand, if the business weakens, your dividend can be cut and your principal can fall with it. That is why, for most people, I prefer the ETF route as a starting point. With a dividend ETF, you are not relying on one company. You are buying a basket of companies. If one of them weakens, the fund can reduce exposure, or remove it. You still have risk, because all investing has risk, but you reduce the danger of one bad executive team or one broken business blowing up your entire income plan. Now, I think about dividend ETFs in three broad buckets. The first is U.S. dividend ETFs. Noble is a well-known example. It focuses on dividend aristocrats in the S&P 500, companies that have increased their dividends for at least 25 consecutive years. That matters because it tells you these are not random businesses throwing off a one-time yield. These are companies with a long culture of returning capital to shareholders and doing it repeatedly through multiple environments. At the time this source material was built, Noble yielded a bit over 2%. Then there is SESH-ED, which is broader and, in my view, particularly interesting for income-minded investors who want us exposure. It focuses on high-quality dividend-paying companies in the United States, and at the time of the source was yielding around 4%. That is a meaningful difference. And the logic is the same. You are not trying to guess one perfect winner. You are letting a rules-based basket do some of the work for you. The second bucket is international dividend ETFs. This is where things become more interesting and also a little more volatile. You are now looking outside the United States at companies that may operate in faster-growing countries or markets with different valuation dynamics. Vimy is one example, IDV is another. At the time the original material was built, Vimy yielded around 4% and EDV around 5%. Why does this matter? Because some overseas companies have the ability to grow faster and distribute more income, especially if they are operating in markets that are still developing or simply trading at lower valuations than similar U.S. companies. But that opportunity comes with more instability. Different political systems, different currencies, different levels of economic resilience. You do not get the extra yield for free. The third dividend bucket is real estate ETFs, specifically REIT exposure. A REIT is a real estate investment trust. There are equity REITs, which own actual physical property, and mortgage REITs, which own or finance the loans behind real estate. VNQ is a major ETF that gives you exposure to equity REITs. REM is an example that gives you exposure to mortgage REITs. At the time the source was created, VNQ was paying roughly 4%, while REM was paying around 9.5%. And this is exactly where people get into trouble if they are undisciplined. They see 9.5% and their brain stops working. But yield by itself is not safety. Yield by itself is not quality. If the underlying asset is fragile, the principal can fall, the distribution can be cut. And what looked generous can turn into a trap very quickly. So when you look at dividend ETFs, I do not want you making decisions based only on the payout. I want you looking underneath the payout. What assets are actually inside this fund? Are these good businesses? Are they durable? Is the income stable? Is the structure volatile? Because if the asset base is weak, the dividend will not save you. The third asset class is more hands-on and more demanding, but also one of the great wealth engines available to ordinary people, and that is direct real estate. When I buy a rental property, I am not buying a piece of paper. I am buying a hard asset. I own the land. I own the structure. I own something real. And if I bought well, that property can put cash in my pocket every single month. Let me give you the simplest version of the math. Suppose you find a 3-bedroom, 2-bath house for $200,000. You rent it for $2,000 a month over a year. That is $24,000 of gross income. But gross income is not profit. You still have property taxes, insurance, repairs, management, and vacancy. A toilet breaks, a roof ages, a tenant moves out, time passes between leases. All of that costs money. So after you subtract the real expenses, imagine you are left with $10,000 a year of true operating profit. Now you ask the question that matters, is that return attractive relative to what you had to put in? If you paid all cash, you invested $200,000 to produce $10,000 a year. That is a 5% cash. On cash return, a 5% cap rate. Style income outcome in the simplest sense. Some people will be happy with that. I am generally not excited by that. Personally, I want more. I like to see something closer to 7% cash. On cash to make the effort worthwhile, on a $200,000 purchase, That would mean I would want something closer to $14,000 a year. Now, people hear that and say, it is impossible. It is not impossible. It is simply work. In easy markets, everyone thinks they are a genius. In difficult markets, the people willing to analyze more deals, walk more properties, negotiate harder, and stay patient can still find opportunities. Real estate is not magic. It is labor rewarded. You can buy all cash, you can use a mortgage, you can syndicate with other investors. But whichever route you choose, the numbers have to work. And once the numbers work, real estate becomes extremely powerful for three reasons. First, steady cash flow. Every good property adds another stream of income. Second, you own a real hard asset, not an abstraction, not just a quote on a screen, a building, a parcel, a physical thing. Third, the tax code is extraordinarily friendly to real estate owners. This is one of the reasons wealthy people love the asset class. Depreciation alone can materially reduce your taxable income. If you buy a property for $200,000 and only part of that is land value, the building portion can be depreciated over time, add ordinary and necessary expenses, management, maintenance, financing costs, and sometimes accelerated depreciation strategies, and suddenly the tax treatment looks dramatically different from a normal salary. That is why a high-earning professional can lose nearly half their income to taxes, while a disciplined real estate investor can generate cash flow and report much less taxable income than an outsider would assume. I am not telling you it is easy. I am telling you that if you are willing to understand the numbers and build the systems, it can be immensely rewarding. The fourth asset class is a business. This is where people begin to separate very sharply. Some people hear the word business and feel alive. Other people hear it and feel exhausted before they even begin. Both reactions are fine, but ownership of a business is one of the clearest ways to replace a paycheck, because when you own the business, you are not just earning a salary, you are entitled to the profits. That distinction matters enormously. An employee is paid to do work. An owner gets whatever is left after the business pays its expenses. So suppose a company generates $1 million a year in revenue and has $600,000 of expenses. That leaves $400,000 of profit. That profit belongs to ownership. Now, if the owner also works in the company, they may collect a salary too. But the real prize is not just the salary. The real prize is the profit stream. There are two basic routes here. You start your own business or you buy one. Starting your own business is hard. Buying one is also hard, though differently. And here is the truth people hate hearing. If you want a truly passive business, you usually need a great deal more capital than most people think. If the business is small, the odds are high that it still needs you. It needs your judgment, your leadership, your labor, your consistency. That means you are not really buying passive income yet. You are buying a job with upside and equity. There is nothing wrong with that. In fact, for the right person, that can be life-changing. But I want you to enter with your eyes open. Business ownership can create a tremendous income stream. It can create wealth far beyond what fixed income assets can do. But if you are not willing to understand the industry, manage the systems, deal with people, solve problems, and put in work, the business will humble you very quickly. A lot of people are seduced by the internet version of entrepreneurship. Very few are prepared for the actual thing. Still, if you are the right person, this is one of the most powerful paycheck replacement assets in existence, because you are no longer living off interest. You are living off enterprise. The fifth category is peer-to-peer lending, or more broadly, private credit. This is where, instead of lending to the United States government, or instead of buying shares in companies, you lend directly to other people or operators who need capital. Maybe someone wants a loan to purchase a rental property. Maybe a real estate flipper needs short duration financing. Maybe a borrower needs capital against an asset. There are platforms and private arrangements that make this possible. Now, I want to be very direct about this one. This can look attractive because the yields are often much higher. You may hear 8%, 10%, 12%, 15%, sometimes even 20%, and that pulls people in. But high interest is not free money. If someone is willing to pay you 10% or 15%, it means they need the capital badly enough to accept that cost. That immediately tells you the risk is higher. If I were lending in this space, I would want collateral, preferably real collateral, preferably something I understand, because default is not some remote theoretical possibility. It is part of the business. So the whole game becomes underwriting, documentation, and recovery. If the borrower fails, what protects me? What claim do I have? What asset stands behind the promise? People make good money in private credit. That is true, especially in real estate-based lending. But if you do not understand the borrower, the collateral, the legal structure, and the risks, then the high yield can be an illusion that disappears the moment something goes wrong. So where does all this leave you? It leaves you with a much clearer framework for how to think about replacing a paycheck. Treasuries are simple, relatively stable, and useful for low drama income. Dividend ETFs give you diversified equity income and, in the right cases, some long-term growth as well. Real estate can produce cash flow, tax advantages, and hard asset ownership, but it demands work and discipline. Business ownership can generate the largest upside because ownership captures profits, but it is not for the lazy or the confused. Private credit can offer high yields, but only if you are honest about the risk and careful about the structure. And now I want to tell you the part most people do not want to hear. None of this works if you are not willing to sacrifice in the beginning. You do not replace a paycheck by thinking about income. You replace a paycheck by buying assets. And buying assets means redirecting money away from consumption and into ownership. It means some years look boring. It means some months feel slow. It means you do not get the immediate emotional reward of spending. You get the delayed reward of freedom. That is the trade. The average person spends the prime earning years of life building habits that require a paycheck. The disciplined person uses those same years to buy assets that eventually make the paycheck optional. That is why I always come back to the same point. Your job pays you when you work. Your assets pay you because you own them. If you want to stop working one day without collapsing your lifestyle, you need enough assets throwing off enough income to cover the life you want to live. And once you start seeing the world that way, every dollar becomes a worker. Every saved dollar can become a treasury bill, a dividend share, a piece of real estate, a piece of a business, or a lending unit. Every dollar has a new job, not to be spent to go out and bring back friends. That is how paychecks get replaced. Not with one lucky trade, not with one hot stock, not with wishful thinking, with systems, with patience, with ownership, with enough discipline to keep going long after the excitement wears off. That is how you make work optional.